So you're considering insurance. That is awesome choice because everybody needs to have protection as the foundation of your financial tree. So let me share with you some education on insurance. You should never go with somebody who won't educate you on multiple types of insurances. Insurances are designed as a financial plan. They are not something that you just automatically give a quote to. We want to make sure that it fits your plan. So here goes, and let me share the screen real quick about different types of insurances. So let me talk about the functions of insurance. So there are five basic functions to insurance. First, you have the death benefit. So that's what we tend to think about when we think about insurance. We think about something to happen, like something to use if something was to happen to our family members. And when we think about something happening to our family members, let's say, like a husband and a wife situation, is that we tend to think about burial. But we have to think about it's the replacement of the income that's going to be lost. So if the wife makes 50,000 and the husband makes 50,000, they usually make their bills, their expenses are in the $100,000 range. So if that partner is no longer there, then that means that they are only making 50,000, but their expenses are still at 100,000, which then makes the whole family suffer. That makes the partner suffer. That also will make the kids suffer. They will not be able to have the same type of living. So that's why it's extremely important to get policies that don't just cover $30,000, $40,000 of loss, but we want to cover big amounts. Usually that $50,000 that you're making per year, you want to multiply that by, you want to easily multiply that by 10, and then that'll be 500,000, and that's what should be the coverage, because it's going to take you about 10 years to replace the income that has been lost from that situation. Now, not only do we need to think about death benefit, but a lot of policies also have what is called living benefits. And living benefits is that if you had a $500,000 policy, that what you'll be able to do is take a portion of that policy and use it for your expenses if cancer was to happen, a major organ transplant, if you had a heart attack, if you had a stroke. Those things will trigger for your usage. And different companies have different areas of triggers. They all do cancer, heart attack, and stroke, and usually end-stage renal failure, but then they also do some other things depending on the different company. And so sometimes they'll also will say terminal illness. If you have like 2 years to live based on whatever is going on for you, then it'll trigger you to be able to utilize that money. So that means take $200,000 off and go ahead and pay the bills up for a couple of years, or do whatever you need with that money. They don't care what you use the money for, but once you take the money, you're able to use it because those things were triggered. The other function of life insurance is this thing called cash value. So cash value is like there's a little account that's along with your life insurance. So you have the 500,000 death benefit for if something was to happen to you. Then there's a little amount of money that's growing along with it. When the money grows along with it, it can be used for retirement. It can be used for college funds. It can be used for just regular savings. And the money is growing at higher level rates than what the bank is offering you with an interest. So that's why we care about the cash value portion. Then also the money is tax-free. There's a tax advantage to putting your money inside of a life insurance policy. The IRS actually allows for a certain amount of money that you can put inside of your insurances, and your money can grow at exponential rates, a lot higher than what it is at the bank. And then also there's estate planning. So that's for people who have payment due to probate. You can utilize that money for those things. So those are the 5 functions of life insurance. So you have to think, what is the most important function for you, right? Death benefit, leaving legacy. Living benefits, you never know what's going to happen. Cash value, oh, my kids do need to go to college. Oh, I do need to have something set up for retirement. I don't want to work forever. And I want to make sure that it's growing tax-free. There's different types of life insurance, and that's what's extremely important for people to understand. There are multiple types. And so when people are just quoting you something, a lot of times they'll quote you one over the other. And you have to understand a little bit about why they're doing that. So the first type of insurance that they used to have before were just term insurances. And the term insurance is really inexpensive. So usually you can get a term insurance for little to nothing. It's like when you see commercials that say, oh, get $1 million term policy for, little to, whatever, $100, if like less than that sometimes. And so they're really inexpensive. The problem is, you have to understand the con of that is that it will expire. It'll expire in either 10 years, 20 years, or 30 years, depending on how it's been designed. So there are great reasons why people get term policies. Sometimes you get a term policy for the 30-year mortgage that you have. So you want to have additional protection during that time. You may want to have additional protection while your children are younger. So during that time, you go ahead and get like maybe a 20-year term because I want to have extra during that time period, right? So that's a term policy. They're really inexpensive, and they will last you for a certain term. But when you're really young, like for me, I'm in my 30s. In 30 years, I'll be 60. I will still be living just based on genetic code that I'll ultimately still be living. And then I will not be able to give any of that money to my kids or grandkids for a beneficiary, because it will no longer be in existence. And you can also convert those to permanent at that time, but it's going to be extremely expensive. Getting a policy at 30 is way different than getting a policy at 60. We're talking about hundreds and hundreds of dollars per month difference that happens between those two different areas. So you really want to pay attention to, do I need a term? What am I getting the term for? The next thing is that when after term came out, they came out with whole life. Whole life is permanent, and it has that cash value that I talked about. However, it can be, the negative is that it can be very rigid, and the cash value only grows at a 2 to 3% rate. So it has a very low rate of return. So then what they created was the universal life, which has permanent, which is good, has cash value, which is also good, and it's flexible. So it gives you the ability to say, if it costs $100, I can put $150, and then extra $50 can go into the cash value to grow more. So it had the flexibility. Oh, I'm in a financial hardship. Oh, I need to move my money down, move it down to $50. It would have that ability to flexible the premium. But the cash value still has a low rate of return, 2 to 3%. Still a lot more money than, or better interest than what you would make if you were actually putting it inside of a bank, though, because your bank is giving you 0.002%. Even when you get even really good CDs are still only giving like 0.75, sometimes 1%, which is not outpacing inflation. We have to really think about inflation. The next type of insurance that came out was the variable universal life. And so the variable universal life is permanent, possibly, question mark. It has cash value, and it's very flexible. Why that's important. The cash value is inside of the stock market. So it goes up and down, up and down, and up and down. And that means that you can have a lot of money growing within your cash value. But during times like when the market crashed, it can also lapse your whole entire policy, and you can lose all that money. So it's a little bit unsafe. And I don't do that in my particular company, but I do the other four. Then what they came out with was the Index Universal Life, also known as an IUL. You can look them up online, IULs, and they're permanent. They have cash value, and they're flexible, but their cash value is inside of an index. And so what that does is that as the stock market goes up, your money goes up. But when the stock market crashes, your money stays the same. So it just locks in. And then and then it waits for the stock market to go back up again. Bam, stock market goes up, your money goes up. Stock market crashes, your money stays the same. And so because you don't have to recover from loss, it really helps you to save a lot of extra money inside of these policies. And the negative side is that they're capped, meaning that if the stock market was to go like 20%, it will probably be capped at 15%. So you wouldn't get all the growth. But when the market crashes -15, your money's going to stay the same. You don't have to worry about losing any money during the crash. And so that's what we really want to care about. So that's extremely important for you to know. Let me show you a quick policy, because I think it's really important for people to see a policy at work, and that can help you. Okay, so here goes my policy. This policy is a $350,000 policy at what is called option B. So it allows it to grow over time, and it costs me $189 per month. Okay, so you would notice right here at 35 that this is going up, and this is how much it is per year, $2,268. And then if you go over to this side of the 7.74%, that is the little cash value area. So the first year in my account, there's $1,390. Each policy has a surrender period. So it's like you have to keep the money in there a little bit of time before you're able to utilize it. So the surrender value is 0, so I can't use it. But if I was to die within the first year, my family would get $351,000. That's just the regular death benefit. We'll also notice that as things go a little bit longer, This year right here is after 15 years, the numbers get the same. So in my account, there's $39,813. And you see $39,813 is money that I can take out for any particular reason that I would like. Just need to call them and get the money out. And then the death benefit has moved up to $389,000. So that's what my beneficiaries ultimately would get. At this, I decided that I want to stop paying around 55 because that's going to be around the time that I plan on retiring. Average people retire around 65, 70, but I designed my plan to fit when I would like to decide to stop retiring. So that's age 55. At that time, there's only $64,044 in the account. That's clearly not enough money to retire on and to stop working. So I have done something a little different. So what I have done is overfund my policy. So this is a next thing. So what I'm doing is I'm overfunding my policy. My overfund is that I'm putting in $600 monthly, and you can choose to do that however you would like to do that. That could be you can choose to do that. When your tax refund comes, you can throw an extra $1,000 or $2,000 in it, so I can still just maintain the $189 as my actual payment. And then when I feel like it, I can throw extra money in there. Oh, I have some extra money. Let me throw it in there. And so the amount that I can go up to is $7,200. So I'm able to only go up to $7,200 per year that I can save. What you'll notice is that if I put $7,200 instead of that $2,000 that I did initially, that my account value will then have $6,091 in there. And already available to me is money in my surrender value. So I can take $4,698 out next year if I wanted to go ahead and do whatever I may need for it within that year. Also, my death benefit has grown to $356. So it's grown, and that's what my beneficiaries would get after 1 year. My goal is making this into a retirement account. So like same thing as the other one, I'm going to stop paying at 55 years old. That's a total contribution of $151,200 over time. Okay. And what you'll notice at 55 is that in the account is $299,932. So that's pretty, it's a nice little chunk of change. And my death benefit has moved up to $649. What my goal is that at age 60 that I will retire and I will utilize this money. So I'm going to be taking money out. So you'll notice that at age 60, it's $430,000 in that account. And I'm going to start taking that money out every single year up until I turn 90. So that's 60 up until 90. So that's about 30 years of time period. So you see that my contribution has still been the same. I only put $151,000 in the account. However, I've taken out of the account $1 million. Still at that point, by the time like 94 hits, there's still about $219,000 in the account, as you can see over here to the right. And then what would be given to my beneficiaries is $569,000. So that's how much money would go to my beneficiary. So I'm still able to give my legacy $500,000 when I have already taken $1 million from this one policy, because I've designed it in a particular way to be able to bless my life and bless the future generations. I have two policies, and they're both operating very similar to this. And so I will ultimately get $2 million out over the course of my life, as well as my beneficiaries. Each one will get about $500,000 each one. So that'll be $1 million that I've been giving out to the next generation. Don't tell me that can't change a whole life. So these are things to think about when you're getting insurance. When you're thinking about making your money grow, you want to know the different enemies to your money. So what is inflation? Inflation over time, things get more expensive. Bread is more expensive. I always think about fast food is way more expensive. Number one at McDonald's used to be $2.99. Now it's like $7 or something. So if that can happen in the last 30 years within my life, that means in the next 30 years, it's going to be very common for a number one to look like easily $13, $14. So we have to make sure we're outpacing inflation. It grows at 3 to 4% every year. Therefore, your money needs to go somewhere where it can grow 4% plus. Taxes, you need to understand different tax categories. If you have money inside of a 401k, you can check out another video that I'll have around understanding the 401k and the taxes. But we want things to be tax advantage. We want to make sure we're able to put money somewhere where we don't have to get taxed on it later on. And we have to understand risk, right? Like, are we putting inside of a bank, which is fixed risk? Are we putting the stock markets going up and down? Or are we following that index concept that I mentioned before, which is, you don't lose your money. So the positive is that you're not losing any money. And the positive is that it's growing at a higher rate than your bank is growing. The negative is that it is getting capped. So that is my message for today. I hope that it makes sense for you. Give me a call if you need to, and I can explain it even further for you. So this is Dr. Roche checking out. Dr. Roche, the remix your thinking, Dr. Rethinking. All right, bye.